I want to bring in Russell Rhoads, who is joining us back on the network, here to take us into the closing bell. He's the head of research and consulting at EQ Derivatives. Russell, welcome back to the show. Congrats on the new gig.
Good to be
Let's
here.
talk volatility. Thank you.
Absolutely.
So I see some bearish kind of tones in your note here, Russell.
Everything I sent you, I put bearish after it. Just making somewhat of a bearish argument for the overall market. It just doesn't feel like we're out of the weeds yet. Alan just mentioned, he kind of stole my thunder a little bit, that VIX is holding in there pretty close to a new low since the beginning of the quarantine, coronavirus, whatever you want to call it. But we're still kind of hovering there in the 27.5 range, while the S&P 500 continues to make a new high. And you can overlay this on price action in 2008, where VIX came in a little bit, then was flat for a while, and we had a double dip. And it seems like everybody out there, there's two camps right now. There's the fear of missing out, who see that we've already rallied 25% off the lows with the S&P 500, and the double dippers. And I'm kind of in the camp with the double dippers that we are going to see another move to the downside at some time in the next few months.
So to be clear, you're kind of getting this from, dividing this from volatility markets, and one of those is that the VIX is not dropping faster, Russell?
Exactly. Actually, I mean, it's I was putting together a chart a little bit earlier that I'm going to tweet out, and basically it looks like a flat line over the last couple of weeks while the S&P 500 continues to climb a little bit higher. We saw a similar pattern in early 2009, and then next thing you know, the S&P 500 makes lower lows compared to where it was in November of 2008. So as long as VIX is holding in there, and also VVIX, which is starting to work lower but is still well above 100, both of those are indications that people are paying up for options. VIX with the S&P 500 options, and VVIX, just think about it as an indication of how aggressively people are paying up for out of the money VIX calls in case we get another volatility spike.
So volatility, VVIX, even though VIX hasn't made a new low here, the VVIX is dipping below that, but still 100 is the point you're bringing up. But Russell, how do we know what magnitude and what levels really matter in this environment that was so unique and unprecedented?
Well, with VVIX, the long-term range is really about 80 to some big moves up to 120. Now we went much higher than that with VVIX earlier this year, but that over/under of 100 is always been kind of an expensive versus cheap line for me. The long-term average is 90, but the majority of time VVIX is closing in the 70s and 80s. So I do feel like a triple-digit VVIX, especially with VIX still at elevated levels. You got to assume, if people are buying VIX call options, they're buying call options on VIX that have a 40, 50, 60. I even saw some 100 strikes trade yesterday. So people, and those look like paper selling, but still, people are trading those things, and that is, there wouldn't be a buyer for those things if there weren't some people that felt like we're going to get another spike in volatility.
One of the other ones, I want to come back to the vol-Q versus VIX, the NASDAQ volatility versus S&P vol. Given the run in the NASDAQ, we know that vol-Q or VXN, whichever you want to look at, is going to be lower than the overall VIX. Russell, do you think this is like a time bomb waiting to happen, that there's just been money flowing into mega cap tech because they don't know where else to put it, and if that ends, we're in trouble?
I think that's part of it right there. Is there's been nice moves into, as you put it, mega cap tech. 40% of the NASDAQ is just a handful of stocks, and several of those stocks are very close to their 2020 highs. So there's not as much concern with respect to that sector, but there's more concern with respect to multinational S&P 500 companies. And when you see elevated concern about the global companies, you've got to assume that there's some concerns about, the overall global economy and what's it going to be like when we come out of this. We continue to do battle with China, and S&P 500 companies are the type of companies that are going to be hurt by that, whether it's a more expensive supply chain because they're not able to buy components cheaply, or losing out on a market that they felt like that they were going to gain entry into at some point.
Okay, so right now it doesn't sound like, Russell, you're a big believer in this rotation trade. The bank's leading. I mean, I guess it's kind of a Rorschach test. You either look at this, and if you feel good about the economy, you like it, and if you don't, then maybe it's kind of like the last stand for this big run we've had.
My feeling with respect to what the S&P 500 is indicating is that it's smooth sailing ahead. We've got we're going to come out of this thing, and maybe we have negative cash flow out of the S&P 500 as a group of companies for 2020, and then we start back on a ramping up in 2021. Pulling any profitability whatsoever out of 2020 actually should only take about 11-12% out of the S&P 500, which is pretty close to where we are right now. But so I think the S&P 500 is priced to perfection. Now, a dip again, the second wave, as a lot of people like to put it, isn't going to have the same sort of impact on the NASDAQ as it would on the S&P 500. If anything, we've got Netflix benefiting from this. We definitely have Amazon benefiting from this. I'm basically on a first name basis with the Amazon person because they seem to be coming here twice a day right now. I got to cut people's accounts off or something. But the large NASDAQ companies, either they haven't gotten hurt by what we're experiencing, or they've actually been beneficiaries. Yeah.
Seems like it's a little bit of both. Some of these really have thrived. Russell, when we look at volatility, I want to just step back and kind of take the VIX curve into account because now that we've had the VIX come in, that October-November period looks a little bit choppy again, that there's that kind of election kink there. After that, it looks like that's kind of now an event again. So that seems to suggest something normal where volatility could be an outlier due to an actual event outside of the virus.
It's we actually had a nice roundtable with some volatility traders a couple hours ago with EQ Derivatives, and we spent a lot of time talking about October VIX futures being at about a 1.5 2-point premium to the November futures. Now, this is occurring because the market thinks that we will still have some uncertainty going at October 20th is the October settlement date. We will have some uncertainty around how the election is going to work out. And that will show up in the pricing of the SPX options that expire in November after the election. The anticipation of that elevated volatility is really, I think, a function of a lot of uncertainty as to how this thing's going to turn out, but also a residual effect of the big surprise that we got in 2016. And not necessarily that the actual election is going to be a volatility event. In fact, the way, if you look at things, it looks like you said, pretty smooth sailing after the election, but leading up to it, it's going to be like an earnings event. And that's how people were equating it today.
Okay. Russell, great to catch up. Awesome conversation here on the volatility front. Appreciate you joining us, Mr. Rhoads.